Hey everybody, today we are going to be discussing the three I's related to real estate investing. The first I is related to income. The second I has to do with improvements. And the third I is related to inflation. So related to income, income derives what you should be paying for a property. It determines what your ongoing cash on cash should be at the property, and it determines what refinance or recapitalization you should be able to achieve at some point after owning the property for a while. And it also determines what your exit value is when you decide to sell the property. The way you determine the income and the value of the property is by looking at the rent roll, determining how much you are achieving in rents on an annual basis, adding in any ancillary income that you might get, parking revenue, laundry income, whatever it may be, CAM reimbursements, and then subtracting off any physical vacancy that you might have, any economic vacancy, or any concessions that you might be giving to one of the tenants. Doing so determines your effective gross income. But effective gross income isn't how you value the property. You also need to look at your operating expenses. So the next thing you do is you look at all the operating expenses at the property level. Property management costs, any payroll costs, any utilities, real estate taxes, insurance, repairs and maintenance, pest control, landscaping, security, anything that would be an annual operating expense that you would incur at that property. You tally up all those operating expenses, and then you subtract that from your effective gross income. That derives what is called your NOI, or your net operating income. And NOI drives everything. NOI drives what your unlevered cash on cash return would be should you buy a property. So if you were generating an NOI of $1 million per year and you were paying $20 million for a property, you would have a 5% unlevered return. That also determines how large of a loan that you can achieve, both on the front end when you first buy the property and also in a refinance or recapitalization scenario. Ultimately, when you decide to sell the property, the NOI also drives what your exit sale price is going to be. And the market, of course, as well. But the NOI is an important number to understand so that you can derive value, purchase prices, and what you're comfortable with from a return standpoint, unlevered. The second I that you need to look at are your improvements. And why the improvements are important is that they can drive further value to the property. If you have the ability to improve the exterior of a property that drives more foot traffic to that property, you can keep the property occupied better. If you do a good job on the interiors of the property and more tenants stay longer, then that will also drive value to the property. Ultimately, you should be able to generate more revenue in that scenario. It should also give you the ability to increase your lease terms, and ultimately, with good capital expenditure improvements, you may be able to increase the useful life of your property, thereby reducing your ongoing annual repairs and maintenance. The third thing that you need to look at is inflation. We live in an inflationary environment, which is a good thing for real estate holders. Generally, costs go up over time. With apartment complexes, self-storage, you can capture that increase very quickly because your leases are generally short. If you are doing commercial leases that are longer in nature, you need to build in the fact that you're going to have increases in inflation in your costs because your annual expenses will increase. So you need to match that with increases in the revenue side. And so it's good to have CPI type inflation calculations or agreed upon step ups in the rent during that time period. So those are the three I's related to real estate investing that everybody should be considering. You need to definitely look at your income all the time. You need to also be looking at the improvements that you can make to add value to the property, and you need to take inflation into consideration. Thank you very much. Till next time, let's continue growing our cash flow and net worth together. We'll look forward to seeing you on the next video with Guardrail Finance. Appreciate it.